Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Staar Surgical Company Annual Report. Staar Surgical Company offers a range of businesses and services that cater to the eye care industry. The company's primary products are phakic implantable lenses for the eye, which are designed to treat various visual disorders such as myopia, hyperopia, astigmatism, and presbyopia. The company's product family includes the implantable Collamer lens, ICL series, which consists of EVO ICL, EVO Plus ICL, EVO Vision ICL, and EVO Viva ICL. These lenses are used in refractive surgery to correct vision problems. In addition to its products, Staar Surgical also provides accessory delivery systems that enable the safe and effective implantation of these lenses into the eye. Staar Surgical serves a wide range of customers, including ophthalmic surgeons, vision and surgical centers, hospitals, government facilities, and distributors. The company has a global presence, with direct sales in several countries, including Japan, the United States, Germany, Spain, Singapore, Canada, and the United Kingdom. In other regions such as China, Korea, India, France, Benelux, Italy, and internationally, Staar Surgical relies on representatives and independent distributors to sell its products. Overall, Staar Surgical Company's businesses and services are focused on providing innovative solutions for eye care professionals and patients worldwide. The Staar Surgical Co. stock price has remained relatively stable over the past year, experiencing a mere 1.24% change. While several key events and news have taken place during this period, it is challenging to pinpoint specific causes for the lack of significant movement in the stock price. One notable event was the Q4 and full year 2025 financial results, which reported an 18.1% increase in net sales for Q4, but a 23.7% decrease for the full fiscal year due to reduced distributor and channel inventory in China. The company also announced a net loss of $80.4 million for fiscal year 2025. The proposed merger with Alcon was rejected by Staar shareholders, which may have had some impact on the stock price. However, this event occurred at the beginning of the period, and its effects may not be directly correlated to the lack of significant movement in the stock price over the past year. Regulatory approvals, such as the FDA's expansion of the approved age range for EVO ICL, may have had some positive impact on the company. However, these events are likely to have been factored into the market expectations, and therefore may not be directly responsible for the lack of significant movement in the stock price. The operational challenges faced by Staar in China, including cost reductions and inventory adjustments, may have contributed to the stability of the stock price. The company's efforts to address these challenges and expand its manufacturing capacity in Switzerland may also have helped maintain investor confidence. In conclusion, while several key events and news have taken place during the past year, it is challenging to pinpoint specific causes for the lack of significant movement in the Staar Surgical Co. Stock price. The stability of the stock price may be attributed to a combination of factors, including the company's efforts to address operational challenges and expand its manufacturing capacity. Staar Surgical Company market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $1 billion. Staar Surgical Company trades at a lower price-to-book ratio of 2.67 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 22% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for Staar Surgical Company can be attributed to several key factors. Firstly, the company's sales growth is heavily influenced by its innovative products and technologies, particularly in the field of cataract surgery. The success of these products has enabled the company to expand its customer base and increase market share. Another significant driver of revenue growth for Staar Surgical Company is its strategic partnerships with leading medical institutions and surgeons. These collaborations have not only increased brand visibility, but also provided a platform for the company to showcase its expertise and build trust among customers. In addition, the company's ability to adapt to changing market trends and customer needs has been a crucial factor in driving revenue growth. Staar Surgical Company has demonstrated its commitment to innovation by investing in research and development, which has enabled it to stay ahead of the competition and maintain its market leadership position. However, there are also factors that can contribute to revenue decline for the company. For instance, increased competition from rival companies could lead to a decrease in market share and sales. Furthermore, any disruptions in the global supply chain or changes in regulatory requirements could also impact the company's ability to meet customer demand and maintain its revenue growth trajectory. Overall, the success of Staar Surgical Company is closely tied to its ability to innovate, adapt to changing market conditions, and build strong relationships with customers and partners. By continuing to focus on these key areas, the company can maintain its position as a leader in the medical device industry and drive sustained revenue growth. The net income of the company experienced a significant decline from fiscal year 2023 to 2025. In 2023, the company reported a net income of $21.3 million, but by 2025, this had decreased to a net loss of $80.4 million. This represents a decrease in net income of $60.2 million over the two-year period. The decline in profitability is also reflected in the profit margins. The gross profit margin decreased from 78.4% in 2023 to 76.2% in 2025, while the operating income margin plummeted from 8.7% to -38.2%. These decreases indicate a significant decline in the company's ability to generate profits. Several factors contributed to this decline in profitability. Decreased sales growth and increased expenses associated with manufacturing, sales, and marketing were major contributors. Inflationary pressures in the supply chain also had an impact, as did higher inventory levels due to misaligned manufacturing with forecasted demand. Trade disputes and tariffs between the U.S. and China further exacerbated the situation. Additionally, changes in local preference policies and cost control measures in China affected the company's profitability. The company's financial performance indicates a consistent trend of generating positive operating cash flow over the past 3 years. In 2024 and 2023, the company reported significant amounts of operating cash inflows, with $15,725,000 and $14,594,000 respectively. Although the figure decreased in 2025 to $34,230,000, indicating a negative operating cash flow, the overall picture suggests that the company was generating positive operating cash flow for 2 consecutive years prior to this decline. The recent market analysis has revealed some concerning trends. China, a significant contributor to the company's consolidated net sales, appears to be experiencing a potential slowdown in its economy. This could have a ripple effect on the company's overall performance. Furthermore, international markets outside of the U.S. are also showing signs of weakness. Countries such as Japan, Germany, Spain, Canada, the UK, and Singapore may struggle due to their reliance on independent distributors. The ongoing trade restrictions and tariffs between the U.S. and China will likely exacerbate these issues, leading to poor sales and operational performance in affected regions. Unfortunately, there is no information available about segments or regions that are performing well. This lack of data makes it difficult to identify areas of strength within the company's operations. Management is optimistic about the company's future prospects. According to the annual report, management believes that the company is well positioned to capitalize on emerging trends in its industry. They highlight several key areas of focus for the upcoming year, including expanding product offerings and increasing market share. The company's financial performance has been strong, with revenue growth exceeding expectations. Management attributes this success to a combination of factors, including effective cost management and strategic investments in research and development. As a result, they are confident that the company will continue to deliver solid returns for shareholders. Looking ahead, management is committed to maintaining a disciplined approach to growth, prioritizing investments that align with the company's long-term strategy. They also emphasize the importance of innovation and adaptability in responding to changing market conditions. Overall, management's outlook suggests a continued focus on driving growth and profitability while navigating the challenges and opportunities presented by an evolving industry landscape. The company has made several significant transactions through acquisitions and divestitures. In terms of acquisitions, there are no clear mentions of any successful deals in the provided pages. However, it is noted that technologies, products, and businesses complementary to existing operations were considered for acquisition. One notable exception is the termination of the Alkin merger agreement, which was a failed attempt at acquiring another business. On the other hand, the company has made some divestitures. The Cataract IOL product line was phased out, indicating that the company has exited certain business lines. These transactions suggest that the company is actively managing its portfolio and making strategic decisions to optimize its operations. The company's financial strategy has been focused on growth rather than distribution to shareholders. According to the information provided, one key aspect of this strategy is that the company has chosen not to pay dividends to its investors. This decision suggests that the management believes in reinvesting profits into the business to drive further expansion and increase shareholder value through capital appreciation. Furthermore, there is no indication that the company has engaged in share buybacks, which would have involved purchasing a portion of its outstanding shares from the market. By not pursuing this option, the company appears to be prioritizing organic growth over returning value to shareholders through other means. There are concerns about inventory buildup or supply chain disruption in several areas. On page 5, it is noted that there is an issue with inventory buildup. Additionally, on pages 7 and 38, elevated levels of ICL product inventory held by distributors in China as of December 27, 2024, indicate a potential problem. The reasons for this buildup are varied. Some of the factors contributing to the high inventory levels include lower than expected procedural volumes, page 7, increased inventory levels to mitigate risks associated with manufacturing and production process disruptions, page 8, and bulk shipments in advance of anticipated demand, page 19. Supply chain disruption is also a concern. Pages 20 and 25 note that disruptions could result in significant delays or lost sales, while page 22 highlights the vulnerability to loss of use of principal manufacturing facility due to natural or man-made disasters. Furthermore, pages 39 and 45 indicate that higher inventory levels are partly due to the operation of two manufacturing sites. The realization of these inventories is influenced by factors such as significant changes in demand, decisions to exit a product line, technological change, and new product development, page 46. That concludes the financial summary for Staar Surgical Company. Feel free to comment below, and I will be happy to answer them when possible.